Hello, everyone, and welcome to the Like a Tortoise channel. Today, I want to talk about Lululemon, and what I will be sharing here today is what I think are the main highlights from both the conference call and the earnings report. For those of you who are already aware, Lululemon is one of my portfolio holdings. I have six holdings in the portfolio, and Lululemon is my third largest position. Okay, so of course the market reaction to the earnings report is critical, right? Because and it will certainly move my portfolio performance at least over the short to medium term because Lululemon crashed almost 20% post earnings. Okay, so it's important for us to take a rational approach to this report and see if the story has changed. And remember, if the story changes, then I will sell the company no matter what happened, right? I don't care if I'm currently sitting on losses or profits. So if the moat is broken, then it doesn't make sense for me to stay invested in the company. And that's how it works for every other business. All right. So today I want to. I went through the earnings report and conference call, and I noted down what I think are the most important things for us investors to take into account. Okay, and I will then use that to make, of course, to make a decision as to whether or not I should stay invested in the company. But I want to share this with you guys, and then let me know in the comments if you agree with my reasoning. Okay, so the stock plunged almost about 80% after weak guidance. Okay, so it's important to understand that they actually beat on EPS, on earnings per share, but they missed expectations on guidance, and I think this is definitely what caused what caused the market to sell off sharply. So the reaction was brutal, as you already know. Of course, it's not every company drops 18% post earnings, especially given the fact that Lululemon was already down about 50%. Okay, so for the stock to crash another 20%, 20%, something must have happened. So let's walk you through the main findings. So let's start with revenue. Okay, sales performance. Net revenues, as you can see, grew about 7% year over year. America's revenue growth was just 1%, and this is weakness because the Americas represent about 70% of Lululemon revenues. Okay, about 70%. You can see that the international revenue grew by about 22%, which is quite strong. Look at growth in China, 25%. Yeah, and that is now 16% of total revenue. So this portion of total revenues are increasing, which is something that I like to see. And the same happens with the rest of the world. Look, 19% year over year growth. And now that's 15% of total revenue, up from 13%. Okay, so you can see that the international growth is carrying the business. However, the US is still 70% of revenue. That percentage is declining. Okay, and it's good. I like that. And the reason I like that is because for years, Lululemon has remained very dependable on the US performance. Okay, and so if things, I like the fact that the company is just expanding into other markets and see, and they should be able to continue to capitalize on this growth in other countries, and thus minimizing their exposure to the US, where revenues have been flat. Okay, you can see that, I mean, 1% revenue growth, and this is definitely what continues to keep investors on edge. It's because this is the core of their business. So even though international sales are growing, it's going to take a while for these sales to actually have a more positive effect on total revenues. Americas is still a big chunk of their revenues. That's why. So look at this, comparable sales. You can actually see that comparable sales only grew by 1%, and in the Americas, they declined 4%. I don't like this. So revenue in Americas grew 1%, but what the reason for that is because they open new stores, and so I'm expecting revenues to grow there. But then if you start comparing existing stores, then you can see that comparable sales actually declined. So this is something not good to see at all. And internationally, they grew about 15%, which is positive. Okay, so let me walk you through here, so you can see that altogether they opened. So they have about 784 total stores. That's up from 721 a year ago. So the company continues to open new stores, which is good. So they, for example, they opened 5 new stores in Americas, um, yeah, and 5 in China and 4 in the rest of the world. So they continue to open new stores, which is good, right? That should contribute to revenue as well. But they definitely need to do something about Americas, and I will walk you through exactly what management said during the conference call that makes me feel confident about the future. Okay. So, but yeah, so here you can see a detailed breakdown. Look at that. So China mainland, rest of the world, total international about 22%, but then we have 1% in Americas, okay? And then the comparable sales a decline, a 4% decline. I just don't like that. All right. So what does that mean? So gross margin was down to 58%, and this is something that management referenced, okay, during the conference call, is that we are seeing margins under pressure. Now, granted, Lululemon boosts very high margins compared to other retailers, okay, in the space. However, I mean, yeah, you can see that the gross margin was down from 59% to 58%. Why is that happening? The reason is higher markdowns, tariffs, and costs, partly offset by higher pricing. So I think Lululemon can afford to raise prices, but that is not sustainable over the very long term. I mean, there's only so much you can raise before customers start shifting to other brands, right, to other products. And so management needs to find a way to decrease costs, because right now, on the back of tariffs and of course inflation and other things that are happening, their costs are through the roof, and so um, they need to try to reduce the overall costs, so they can so that together with price increases they can expand those margins. Okay, you can see that operating margin declined from 20 almost 23% to 21%. Net income was also down, so the net margin was about 14.7%. It also declined. And then you can see that, look, the cost of revenue grew faster than sales. Okay, this makes sense. Why? Because of what we highlight here. Another thing that I noticed is that if you look at the balance sheet, you can see that the inventories, year over year, inventories increased 21%, while revenue only increased 7%. This exposes the company to more markdowns, which means they're going to have to, in order to get rid of that inventory, right, they're going to have to lower prices. And lowering prices may eat into their profitability, okay, and thus will affect their margins. So not something great to see, but based on what management mentioned during the conference call, they already recognized the issue. Okay, so they believe, and I will, like I said, I will walk you through this in more detail ahead. But they already recognized the issue and laid out a plan to mitigate these problems, and that should boost revenues. Okay, which will minimize the effects of increasing inventories. Okay, so operating cash flow down 63% year over year. You can see that capex was up about 178 million due to new store openings. but they say they will not just overspend. So they will keep capex in check, and they are always tracking the return on investments, which is very good. Okay, but so from everything that I just discussed, which was essentially the main highlights from the report, there are a few things that are quite concerning. So one of them is, and I already told you about this, the US slowdown is accelerating. Comparable sales declined 4%. Okay. The US still represents 70% of sales. So weakness here outweighs the gains in China and the rest of the world. If this trend persists, I believe international growth can fully offset US softness in the near term. Cannot fully offset US softness in the near term. We cannot expect this to happen, and this is what analysts are probably coming to grips with. So they understand that the problems the company is facing right now are not going to be solved over the short to medium term. This is something that will probably only improve from next year onwards. And management themselves says that a lot of the product innovations they want to release to the market and a lot of the changes will not so we will not see the effect of those until next year. Yeah. So US is the profit engine. If comparables keep falling, comparable sales, margins will remain pressured no matter how fast China grows. And then margin compression. So we have all the margins are down, cost of revenue grew faster than sales, which is a classic signal of eroding operational leverage. Ideally, what we want to see is growing revenues, right? At the same time, the cost of revenue is decreasing. That's operational leverage. We are seeing the opposite with Lululemon right now. Okay. And then another thing in the report is that sales SG&A also increased as a percentage of revenue. So the company is spending more on selling, general, and administrative costs. And this, of course, is helping putting pressure on operating margins. Tariffs and markdowns are eating into profitability. There's no doubt about that. And rising costs suggests they are losing efficiency just as growth slows. What about the inventory buildup? So we have inventory growing faster than revenue. This suggests either over ordering or slowing sell through, which could lead to future markdowns. I think this is a risk for the company. In fact, it's already happening. Okay. So for an apparel retailer, rising inventory faster than sales is one of the clearest red flags. It foreshadows more margin pain ahead. What about the weak cash generation? Let's not forget that operating cash flow declined 63% year over year, while the cash on hand dropped 28%. This is part of the reason also why the interest income declined as well, because now that they are investing to stay competitive, to release new products, to open new stores, to expand operations worldwide, well, mainly in China and the rest of the world, of course, but so the cash on hand got depleted, right? It dropped 28%. And this means the Lululemon is getting less money, less interest on that cash, which ultimately will put downward pressure on net income. Okay, rising capex 23% means free cash flow is under pressure, and it's definitely under pressure. So they are investing aggressively in new stores. Remember, they continue to expand. However, if core US demand weakens further, this expansion could become a drag rather than a growth lever. And I want to keep a very close eye on this. Management has mentioned that they will likely start seeing the effects of the new product lines they are by next year, right? By the beginning of next year. I want to see if that will boost revenues in the Americas. All right, because think about it: if the company is facing a lot of headwinds, okay, but they continue to open new stores, they are not solving the problem. That's not the core issue here. Okay, no matter how many stores you open, if then you are losing, if then comparable sales continue to decline, that is structural. And so I want to confirm that that is not the case going forward. Guidance reaction. This is the third quarter that management lowers guidance exactly as a result of tariff pressures and the macro headwinds. So despite earnings beat, forward guidance disappointed. So this is what contributed to that 20% decline after hours. They say that management is so this tells you that they are not confident about a quick rebound. In fact, they expect the next quarter to be pretty weak, particularly in the Americas, where they expect revenue to stay flat or a slight decline. And the market, of course, is repricing Lululemon not as a growth compounder anymore, but as a maturing apparel brand facing structural headwinds. So if I now go here to, let's go to stock and lock, and I will show you the valuations at which, well, the PEs at which Lululemon typically has traded for over the last decade. Let me put this here. And now let's go here to financials, and let's go to metrics here over here. Metrics here over here. Let's see, where is it? Here we go. You have the price to earnings ratio. If I go back to 2024, you can see that the average is about 39.98. Okay. And right now, what is this price to earnings? Let me change this to exactly, because right now, if I go here to Lululemon, what's the current PE of this company? It's about 11.60. Okay, so if I go, I'm not sure this data here is entirely accurate because the PE is definitely lower. So let me check something here as well. Just so you guys can see annual ratios. Where is the PE ratio? Right here, okay? So you can see that the PE ratio has declined sharply, even if we just compare it to 2021. You look at this. You can see it was in 2024 it was 38, 2023 46, 41, even 72 at the height of the pandemic, right? But then now we are just trading at 11.40 times earnings. So the market is definitely repricing Lululemon. It was seen for many years as a growth company, and now it seems that the market is pricing the company as though the growth has dissipated, in that the company in that, well, that growth story is no longer occur going forward, which means the market is expecting revenue growth to slow down, to continue on the path they are right now, just low single digits, and that reflects the bearish sentiment. Okay, so I think it's important to note that. Let's go back to our analysis right here, right? Lululemon. So I'm not denying that Lululemon definitely faces strong headwinds. So we have tariffs, but what's important to understand is that apparel brands making products in Asia, namely China and Vietnam, are being hit hard. Nike and Adidas, for example, have already raised prices in the US to offset this. So what I think it's important to understand is you have to understand whether these issues are unique to Lululemon, or if they are happening across the industry. If that is the case, then we are dealing with the macro challenges as opposed to company specific issues. in which case that tells you nothing about the mode of the business. Okay, and what I see is that if you compare Lululemon to their main competitors, Lululemon continues to grow revenue at a at a faster rate, and the company is a lot more profitable than its main competitors, boasts much higher margins, and yet the stock is priced cheaper. Yeah. So I mean, I think we still have a very a very well attractive investment case right here, and I'm going to show you exactly what I mean. So look at that. Let me zoom. Let me zoom in on this. You can see, for example, let's compare. You have Nike and Adidas, which are definitely Lululemon's main competitors. And you can see that the gross margins, look at that. Nike has about 42%, Adidas 51%, Lululemon not long ago had about 59%. And now this has slightly declined, right? So it's no longer 59 plus. It's more, if I go here, it's, where is it? Yeah, so it's 58.5%, still well above their main competitors. And you can see that they are even greater than Deckers, which is another company that is going pretty rapidly. Look at their operating margins, EBIT margin. So you can see that recently the operating margin collapsed. Okay, that's true. Let's go back to our sheet. Operating margin now sits at about 21% from 23%. And now if I show you this, you can see that even at 21%, their operating margin is far higher when compared to Nike, Adidas, Gap, and it essentially very close to Decker's operating margin. Okay, and yet the company is priced cheaper compared to other companies. And what's also important to understand, and this is part of the reason why I decided to invest in Lululemon instead of investing in Nike, is because of the growth story. Nike is a far more mature company, right? So they are all over the place already. But Lululemon, they are in the early stages of international expansion, and so I believe the growth in the data backs that up. Is that as they continue to open new stores across the world, I think that will definitely boost revenue and profitability over time. And I think the company is trading very, very cheaply today. Okay, so yeah, this is important. So we talked about margin compression, guidance reaction. This is all. I want to tell you about this as well. So in terms of guidance, look at this. The guidance took a big hit because for the third quarter, they expect revenue to be in the range of 2 billion, 2.5 billion, and that initially they were expecting revenue to be about 7%. Now they lowered their guidance to 3 to 4%. That's a substantial decline. And diluted earnings per share are expected to be in the range of 2.80 and 2.23 dollars for the quarter. That is another big decline. Okay, because what that means is, where is that? Right here. Diluted earnings per share are now expected to be in the range of 12.77 to 12.97 for the year. Initially, they were expecting earnings to be between 13-ish and 14-ish. So you can see that this is material. It's a big decline. And so if we take this earnings per share, and if we let's put a valuation, so let's value the company on a forward PE basis. Okay, the stock is currently trading at about 167. So if we do, let me pull up the calculator. If we do 167 divided by 12, let's take the lower range divided by 12.77, you can see that the company trades at a forward PE of 13 times. This is cheap. But the thing is, will earnings rebound from next year? Okay, and that is the risk. What if management cannot deliver? What if the new product line that management is talking about doesn't pan out as management wanted to happen? Okay, in this case, what seems to be cheap can actually become a value trap, because what that means is that earnings will continue to decline. Okay, and so if that is the case, then the PE will go higher, actually. Okay, so it's important for us to have to bear this in mind. But here are some reasons that I think we should remain optimistic. Number one, international expansion. I think, yes, China, I think the US still contributes a lot, but I think international momentum is nothing to be written off. And I think this trend is set to continue, which can bode very well for the company long term. The company still boosts strong margins. It's not that like the company's margins are collapsing compared to other companies. They are still outshining other companies on a margin basis. So I like that. Okay. They still have a solid balance sheet, right? No debt. This is very important. No debt, which gives them plenty of flexibility for buybacks and reinvestments. Not to mention the cheap valuation, as we've already discussed. So, for example, Nike is trading at a forward PE of 40 times. However, if I go here to stock and lock, and if I show you Nike's revenue growth, in fact, let's compare them. So let's go here to Insights, and let's compare both these companies. Look at that. So Nike has seen its revenue decline by almost 10% over the past year, while Lululemon has grown revenue at about 9.39% over the past year. So sales continue to increase on the back of tariffs. On the other hand, Nike's revenues are declining, and yet the company is priced. The company is priced for perfection, if you ask me. Okay, because a forward PE of 45. Yes, I understand that Nike's moat is more. The Nike's moat is wider. It's a more mature company. It has been around for many, 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 many years. However, I would argue that a forward PE of 45 is too high a price to pay for a company that has seen its profitability and revenues decline as well. Okay, and that's my case. Not to mention the fact that Lululemon's revenue has a lot more room to grow because the company's market cap is smaller, way smaller compared to Nike's, right? And yeah, so this is part of my bullish case. So yes, the company has its challenges. I don't think they are going to go away anytime soon. However, I would argue that I really like the conference call. I think management. I like when management speaks very transparently with shareholders. And if you listen to the conference call, you will see that Calvin McDonald, the CEO, very transparently mentions the problems the company is facing and ways they are and what they are doing right now to mitigate those issues. And I think that's very important, okay? Because we don't want conference calls to be sales speeches. We want them to tell us things exactly as they are. And Calvin went out of his way to actually do that, okay? Because he recognizes, he even says that he is disappointed, as you can see right here in the report, while we continue to see positive momentum overall in our international regions in the second quarter, we are disappointed with our business results and the aspects of our product execution. This is very important. We have closely assessed the drivers of our underperformance and are continuing to take the necessary actions to strengthen our merchandise mix and accelerate our business. One of the things, one of the big headwinds for the company's competition. There has always been competition, but management mentions, and I think it's fair to say it, that competition today is stiffer than it used to be. There are many copycats, and then you have companies like Alo Yoga, which sell which sell you can look Vori and Alo Yoga, and that they are targeting Lululemon's premium niche with lower prices. Okay, so I think part of the pressure is definitely due to competition, but I think most importantly is to do with the macro headwinds, and I think this is something that affects all companies in the space, but Lululemon is well positioned to weather that storm due to their strong balance sheets, strong cash flow generation, low debt, in very strong margins. Okay, so look, my take is I don't intend to sell my shares. In fact, I want to buy more shares, and I will be doing that over the next week. But one of the things that would really encourage me is I want to see what insiders are doing now that the price is trading at its cheapest valuation ever. And I think if I go here to freeform, and if I so yeah, exactly. Going all the way back to 2014, you can see that this is the lowest valuation the company has ever traded at. Look at that. Is about 160, which is more or less where we are right now. Okay. And yeah, and this was exactly, so it was yesterday, even yesterday. So yeah, this is the lowest valuation the company has ever traded at. Even if I use the price to free cash flow, um, it's definitely one of the lowest value. Yeah, it is the lowest, exactly 15.94. So the company's trading at its lowest valuation in history on a PE and in price to free cash flow basis. And I want to see insiders buying shares. So you can see that McDonald was a seller of shares not that long ago in June. There are many reasons insiders could sell, but they will only buy shares for one reason, okay? Because they believe the stock is going to go up. And now that the stock is this cheap, I want to see skin in the game here. So I want to see them increasing their exposure, namely the CEO and the CFO and all the executives, of course. So look, I hope you found this analysis insightful. And and yeah, so this is one company I need to keep a close eye on because I want to see that the fundamentals are not. I want to see that the story hasn't changed, and I don't think we will see that until sometime next year, until the beginning of next year when they launch the new products, and then they. And then when they launch the new product line in hopefully will give the Americas revenues a boost. Okay, will once again spark excitement among their American consumers. They have a very strong brand loyalty, and I do hope they continue to capitalize on that. Okay, so yeah, the next earnings review. So I already created another document for Ulta Beauty. They reported stellar earnings, and I really like that. Um, so that's going to be my next video. My next video will break down the earnings and conference call. Ulta Beauty is also one of my 6 holdings, and so yeah, that will be my next one. So yeah, just let me know in the comments if you like this and if you want me to post more content like this one. Have a great rest of your Saturday.